Welcome. In this video, we're going to talk about our most recent client letter. It's for the first quarter of 2019. And in this letter, we're going to welcome back volatility. We're going to talk about Recession Watch 2019 and how our 5 core principles help us navigate this environment.
Welcome back, welcome back, welcome back.
In the fourth quarter of 2018, we saw one of the largest spikes in volatility in recent years. Now, the reasons for this spike in volatility were widely known. Political uncertainty, trade uncertainty, increased recession risk, is the Federal Reserve making a policy error, potential bad earnings coming down the pipeline. All these risks and all this uncertainty was known before the market sell-off. But that's the nature of markets in the short term. They're not well-oiled machines. It's more like a 3-year-old. Sometimes they're happy, sometimes they're moody, they're never rational, and they are never predictable. Maybe the sell-off and the increased volatility was signaling a potential recession. But another highly likely scenario is just some de-risking. You can't have a bubble burst if there is no bubble. We're not downplaying risk. Risk is always there. But what changes day to day is how that risk is priced into the market. The riskiest markets are bubbles, where risk is vastly underappreciated, if at all. We don't think we're in that type of environment. The recent spike in volatility reprices security given this newfound appreciation for the risks that we mentioned earlier. Our surefire prediction is that a recession will occur someday. It could be Federal Reserve policy error, it could be the trade wars, it could be some other exogenous event, but someday this current business expansion will start contracting and a recession will occur. But right now, the environment that we are in is unemployment is still low, interest rates are still low, fiscal policy is still in expansion mode. While this has been one of the longest post-recession recoveries, it has also been one of the weakest. So there is potential for scenario for a longer and lower growth going forward. One of the bigger indicators out there for a potential recession is the spread between the 10-year and 2-year US Treasuries. When this spread turns negative and is inverted, it signals that a recession is near. Now, an inverted yield curve does not cause a recession. It just means the conditions exist potentially for a recession to occur. Now, going back to 1956, every recession has had an inverted yield curve occur before the recession hit. Even though the track record for the inverted yield curve is pretty good, there's some flaws. One, it doesn't tell us the exact date when a recession is going to occur. On average, it inverts 2 to 3 years before a recession happens. It's a long time to be waiting around to potentially have a recession happen. Another thing is the inverted yield curve doesn't tell us how bad the market sell-off is going to be during that recession. Is it going to be a mild 15% like we saw in the 90s? Or is it going to be a bigger one like we saw after the tech bubble burst? Because we don't know how bad the market sell-off will be in a recession, or when it will occur, or if one will occur, we try to focus on the things that we can control in our investment process. And the things that we can control is our 5 core principles. Number 1 is asset allocation. The right mix of stocks, bonds, real estate, and other asset classes are the primary driver of the returns and the fluctuations or volatility within your overall portfolio. And that asset allocation is going to be based on your objectives, your time horizon, and your goals for your money. Number 2, volatility is not risk. Like we said in a previous video, the real risk to your portfolio is the permanent impairment of capital. And what we see causing the biggest permanent impairment of capital is policy abandonment, abandoning a well thought out asset allocation strategy during periods of increased fluctuations in the stock market or volatility like we saw during the fourth quarter of 2018. The volatility that we saw in the fourth quarter of 2018 is a chance to take advantage of it, to rebalance or to invest more cash into those securities that have been repriced, and now the risk reward ratio is much further in your favor. Number 3, price you pay determines your return. Pay too high a price for any asset class, your risks go up and your returns go down. Howard Marks has famously said, there are no bad assets, just bad prices. For example, let's look at Cisco in the late 1990s. Investors purchasing Cisco at a nosebleed earnings multiple of 198 at the end of 1999 would have paid $53 per share. Today, the stock trades for $43 per share, and even with dividend reinvestment, shareholders would not have made money in the stock over the last 18 years. But over the same time, the company has nearly tripled their earnings. The stock simply performed poorly because all of that future earnings were baked into the price in the late 1999. This is an example of a good company with competitive advantages and good earnings growth, but a bad stock investment. We focus on investing in assets at prices that make economic sense. Quality and future prospects play a role, but price matters a lot. Number 4, time is your ally, but returns are not linear. At the end of 2009, investors in the S&P 500 had endured 10 years of negative annualized returns. $10,000 invested in 1999 is about $9,000 at the end of 2009. And you can't blame investors for bailing on stocks at that moment because it looks like they don't work anymore. But 9 years later, at the end of 2018, that same $10,000 would now have doubled. It would be worth almost $24,000. Asset class returns come from being invested. The longer that you can stay invested, your odds for success increase. Number 5, no one can predict the future. Too often, investors make a prediction about the future and they marry themselves and their portfolio to that prediction. The thing is, the stock market or any equity market is a very complex system. The chances that you have not incorporated all the information, all the facts, is very, very high. And the odds that you've made a mistake are also very, very high. But let's say your prediction is right. The question though is, how long does it take for that prediction to be proved right? This all leads back to the behavior of abandoning a well thought out policy that will help you meet your long-term goals and abandoning it at the wrong time. And at American Money Management, we don't invest based on big, bold predictions. We try to understand the current environment and invest accordingly. That usually means investing based on the odds and making adjustments around the margins instead of making all or nothing bets. And if you want to read our full first quarter letter to the clients, there's a link in the description to do so. And if you enjoyed this video, please hit subscribe, and then we'll catch you next time.